Hi everyone. In part 1, we saw how to build a cash flow forecast template. In this video, let's try to understand the figures in the forecast and see what it tells us. Firstly, let's look at the month of January 2025. If we prepare this forecast exactly after December 2024, then we can put in the actual cash balance as at end of December 2024 as the opening cash of January 2025. Let's say in this case, it's the actual opening cash and it is $18,000. The total cash inflows that we expect to receive in the month is $145,000. The total cash outflow means the total payments that we expect to pay for the month is $86,000. The net cash movement for the month would be total inflows minus the total outflows. So for January 2025, the net cash movement is a positive amount of $58,000. This shows that for January, we expect to receive more cash than we spend. Finally, we have the ending cash. Ending cash balance is the sum of opening cash and the net cash movement. Since our opening balance and net cash movement are positive, the ending cash balance is also a positive figure. So at the end of the month, we forecast to have a cash surplus of $76,000. The cash position for January looks good as we would have enough cash to pay for all our expenses. It would ensure smooth operations of our business and we would have extra cash to spend for any unplanned expenses. It's a good practice to have a minimum balance limit to provide cushion for any unexpected expenses. In this example, I have set the minimum balance to $10,000. You can choose a different amount based on your business. So, if for any of the months the ending balance drops below $10,000, then you need to take measures to bring the cash position above the minimum amount. For January, it is above $10,000, so there's nothing to worry. Now, let's look at another example. Let's say in February 2025, the cash sales and collection from customers dropped. But there's only a slight drop in the outflows as you still need to pay for the fixed costs. The net cash movement is a negative $21,000, which means the total outflows are greater than the total inflows. So this is the outflow and this is the inflow. But the ending cash is still a positive amount as we had the opening cash to cover for the payments for the month and still has a cash reserve of $55,000. Let's look at another example that has a negative ending cash. Let's say in March 2025, the cash sales and customer collections still remain low, and we have a total inflow of $40,000. In that month, in addition to our regular payments, we also expect to spend to purchase machineries which costs $20,000 and we have other additional expenses of $10,000. The total outflow is $120,000. Thus, the net cash movement would be a negative $80,000, indicating lesser inflow to cover for the outflows. Moreover, the ending cash is negative $25,000, means the cash inflow generated in the month and the savings from previous months are not enough to cover for the huge payments in March. I'm going to highlight this in red. This negative position clearly indicates that we need to take steps to manage this position. For example, come up with strategies to increase sales and customer collections, and negotiate with vendors to defer some payments to future months as the forecast shows a better inflow in the coming months. So, this is how you study a cash flow forecast, derive useful information from it, and devise plans to effectively manage your cash position. Thanks for watching.